Now, Attacq has upgraded its full-year earnings outlook. That's after reporting stronger interim results driven by solid property income and high occupancy levels. Distributable income per share rose nearly 10% during the 6 months to December, while the interim dividend increased just over 9% to 48 cents per share. The group says occupancy across its portfolio remained strong at almost 94%, with rent collections slightly above 100%. Given this, Attacq has lifted its full-year guidance and expects distributable income per share growth of between 11 and 14%, while maintaining a dividend payout ratio of 80%. CFO Peter de Villiers joins us now to unpack the numbers. Peter, thank you so much for your time this evening. Now, the group sounding quite confident when it comes to the second half. As I mentioned there, you've lifted your DIPS guidance. What are the key growth levers giving you confidence to upgrade those expectations?
It's actually a number of things. Firstly and foremost, it's obviously we've got some good rental escalations coming through, but that's all contractual. We've also brought online some new buildings. That's part of our waterfall pipeline that's coming online. Specifically in this case, we've completed a new data center. So as new pipeline developments come on, we add earnings, and then it's largely a historical work done on our debt. So we've still got a favourable net finance charge impact coming through due to lower margins. Other than that, it's filling vacancies as well. Maybe we've been a bit conservative. One doesn't want to build your forecast on being overly aggressive on filling vacancies, and we've managed to fill a few vacancies sooner than what we had anticipated.
Now, you've also flagged macroeconomic risks as a potential, risk to your guidance. And I'm wondering whether the local government elections coming up and some uncertainty around the future of Johannesburg leadership, whether that's been factored in as a potential risk as well.
Not necessarily. Obviously, macroeconomic, one has to factor in, but one can only do so much to control the uncontrollables. I think you mentioned it earlier. What does macroeconomic uncertainty bring? It brings imported inflation. There's a prolonged energy crisis of some kind, and that filters through always into food and obviously shopping patterns. So we can only do what we can to control those. As for local government elections, I think there's often a lot of uncertainty around those, but we've seen obviously more recently that things generally turn out as one's planned, and one can only hope that we can continue to work well with the local governments in the areas that we have assets in to bring about a meaningful change in infrastructure.
All right, let's look at things you actually can control, zooming in on the operational performance then. Peter, occupancy has moved up to around 93-94% with strong tenant retention. Are you seeing a strong leasing demand across the portfolio now? And where are the pockets of the strongest demand?
Retail continues to be strong, although it is coming off a high base. If you look at all of our retail assets, I think we have 98% occupancy or higher. But traditionally, our retail has always been very strong. They're high-quality assets. The office market is obviously the one that's been through probably the biggest beating in recent years. But we're definitely seeing a return to office, a return to work policy, and that obviously drives office demand. There is still a lot of vacancy out there in general, and we obviously compete against that. But it's been good to see that market rentals are growing slowly in the sector, and there's definitely more demand. Although that doesn't mean it's not a competitive market, it is. So that remains an opportunity for us. That's where our largest pocket of vacancy sits, and that's a continued focus of us for the next 6 months is to, can we fill up that space, and then obviously that'll drop to the bottom line.
Digging deeper into the dynamics playing out in the office market, would you say we're seeing a structural shift as firms adapt to the hybrid model, or are we still in that recovery cycle?
I think businesses are definitely a lot further down the line and have largely figured out what works for them. As you mentioned, there is clearly a hybrid model in place in many businesses, and they need to figure out what's best for their culture. It's not just about productivity; it's also about organizational culture and learning. So, we'd obviously like people to be back in the office 5 days a week. That talks to our asset class. But we definitely seeing office clients, spending a lot more on their fit outs. In other words, they're trying to make their office environment a much more pleasant experience, and using that to make sure their staff are back in office more, communicating more, collaborating more, and obviously experiencing just driving their businesses more. I think it's actually very difficult personally to be running a business entirely online, and I think a lot of employers have seen that and have called their staff back.
Let's talk about the pipeline, the development pipeline. There's about 2 billion rands worth of development activity underway, mainly focused on Waterfall City. How are you thinking about pacing new developments in this current environment?
We obviously look at them very carefully. We make sure that because we're allocating capital there, that we must get earnings accretion in the short to medium term. We've only got so much capital to spend, and so we're fortunate to have the canvas that is Waterfall to erect new developments. So you'll see in our pipeline, we've only got one speculative development that's just been greenlit on the industrial side. That's a 17,000 square meter industrial box. The other developments are generally tenant-led. We do currently, however, have an office development of about 10,000 squares, which is speculative, but that's been leasing well. So we obviously need to keep a firm pulse on what the demand is, but we're not going to go overboard on putting too much money to speculative developments. It'll be a slow, measured, and considered allocation of capital as we go forward. But that's been our approach for a number of years. It would obviously help a lot if the economy plays ball. And it did seem that things were lining up for a good run in the economy in terms of interest rates, strong rands, etc. Now we've got some macroeconomic risk on the horizon.
I mean, it always seems like when we get things right, there's always a spanner in the works thrown in. But yeah, I guess we wait and see how things develop. Peter, thank you so much for your time and just walking us through the 6 months that was for Attacq. Now that was Attacq CFO Peter de Villiers.